So, in this episode, I want to talk about some zombie companies. And we're getting more and more of these zombie companies in the US, in the world, anywhere where governments are providing stimulus, which is pretty much everywhere. And so, the problem with these zombie companies, and let me just define them. If you go to Investopedia, for example, and you find the definition of a zombie company, it says zombie companies are companies that earn just enough money to continue their operations, so they don't go bankrupt yet, because they have enough, let's say, cash flow to continue their operations, but they can't pay off their debt. And so a lot of the times they have to take in more debt in order to just survive. And they can't actually pay back the principal on their debt, but they're, because interest rates are so low, they don't really go bankrupt, they don't die off. And the problem with having too many of these companies, is that when you have too many zombie companies, these companies are inefficient. These companies waste a lot of resources that better companies, that would take up more market share, instead of having the zombie companies take up the market share. The better companies would use the scarce resources in a better way than all of the zombie companies would. And so that would basically allow scarce resources to be used more efficiently, less waste, and you're going to have better and cheaper products, services, whatever. And so basically, the more zombie companies you have, the worse it is, and the less money people make, uh, on the shareholders side or on the owner's side. And on the consumer side, they're getting worse stuff. And so zombie companies are not good. They're definitely not things you want to have in the long run. And the thing with zombie companies is that you're always going to have some, right? There are always bad companies, and there are always unprofitable companies that are continuing uh, to be run. So people want to have their companies keep on running even if they're not profitable. Maybe they think it's going to be profitable in the future. Most of them aren't, but some people want to run them anyways, just because they're optimistic about their company. And so most of these guys fail, but with a lot of the monetary policies and also some of the stimulus, like fiscal stimulus we're getting, these zombie companies are just living. They're not dying. And that's a problem, with all of this stimulus. It's that it leads to a lot of these zombie companies, and then you have less and less market efficiency, and you have worse and worse companies dominating the market. So I want to kind of break this episode down and go into a little bit about how much zombie companies we have to begin with in the United States. And the estimates are at around 20%. So basically 20% of companies, roughly speaking, can't pay back the principal on their debt. And that's a big number, 20%. That's 1/5 of companies. And I think I'm talking about public companies, by the way. Private companies, it's harder to find a more accurate number, but public companies, the estimates are around 20%, maybe a little bit lower. And so the problem you can obviously see there is that there's too many zombie companies. And that's what you had in Japan back in the 1990s-ish period, when the government was bailing out all their companies. And so they just end up having all of these, bad companies, and they have, years and years of just stagnation. just a decade long recession. Not necessarily a recession, but just falling economy, falling numbers, falling GDP. Just everything's going downhill for decades because the government is keeping the zombies afloat, but they're not allowing the market to reset. But at the same time, in that situation, they're also not causing uh, inflation. In Japan, their biggest fear is deflation, not inflation. And so, if you go that path, then yes, the zombie companies are not good for your economy, and your policies that you end up applying could cause deflation if you don't apply enough of it, which is usually the least of the worries for politicians and whatnot, because everyone wants inflation, especially once your country is full of debt, especially once if you have rates rising, if you have deflation and your interest rates are rising. Well, well, then the problem here is that a lot of these zombie companies are going to go broke. I mean, they're already broke, but they're going to go bankrupt. And so, instead of being a living dead company, they're going to be a dead company. And so that puts more pressure on the politicians who uh, bailed them out once to bail them out again. And so, well, what happens there? Okay, well, you bail out let's say interest rates rise. Um, then what happens? All of these, there's 20%. The estimate is 20% of US companies are zombie companies. So let's say interest rates rise by even a bit. Well, then you're going to have, almost 20% of companies publicly listed, at least in the US, just file for bankruptcies because these guys can't support rising rates. They already cannot pay back their principal. These guys could barely pay back the interest in such a low interest rate environment. And so with that, if interest rates rise, and you have people like Jamie Dimon predicting that interest rates will rise, and so that's why he's holding cash and he's not touching 10-year bonds or 10-year treasuries with a 10-foot pole. And so he's expecting rates to rise. I bet Warren Buffett's also expecting some type of pullback in the market or expecting rates to rise. And inflation predictions right now are at very high levels once again. And so, is the Fed going to have to taper? Is the Fed going to have to let rates rise? At some point, they have to do something about inflation. And not necessarily that, the Fed can't necessarily solve the economic issue, but they could solve, an inflationary issue by creating deflation. Of course, that would not rejuvenate the economy. The economy would still perform really poorly. It's just, except you're just going to have a more balanced poor performance of inflation and deflation and asset price deflation. Probably not asset price inflation, unless if you want to go into hyperinflation territories. And so the economy is not going to do well if you keep on getting inflation and the Fed starts raising rates. And if you do get raising rates, well, then what happens to the zombie companies? 20% of companies fail. And what ends up happening as well is you get a lot more companies that once weren't zombie companies become zombie companies. And so that's just a big, big door that no one wants to open, because once you open it, it's, once you let the zombies in, it's kind of hard to let them out. Are you going to let rates rise? Well, if you do, then all of them fail. And so basically, if you look at it from a political position, well, you saved all of these companies for all these years, and you spent billions and billions of dollars saving them, and trouble comes again. I mean, how can you just let them die this time, right? So you've already spent so much, you've already put in so many chips onto the table. You can't just take them back once you lose again. So what's going to happen is, at least from a political position, is that politicians are going to be, I mean, almost forced to save these companies again, because they've already been saved so many times that there's really no uh, pressure to. I mean, no one wants the politicians to stop saving them, because obviously people don't care as much about in long-term outcomes as they do about the short term. Because let's say all these companies fail, then yes, a lot of the zombie companies that fail will uh, just die, and the employees will lose their jobs, and of course their owners will lose a lot of money. But in the long term, that employee, that human resource, the labor is freed up to do some other jobs that could be, let's say, higher paying, or that's more productive. Because if you're in an inefficient business, well, then the labor that you're producing is probably going to be less efficient than the labor that you would be producing at a more efficient business. And so, those are some of the short term issues. Of course, asset prices are all going to crash if you let 20% of US companies just go bankrupt. Asset prices are going to crash. Of course, junk bonds, the rates for those are going to just skyrocket, because not only can't the zombie companies, who are mostly the ones issuing the junk bonds, and not only can't they pay back the money, they can't pay back the principal, but now they can't even serve their interest if interest rates start to rise. And these zombie companies, um, there's more and more of them who go bankrupt, and the ones who weren't, the companies who weren't zombie companies, now their profit margins fall. Interest rates are rising, they're not making as much money. They have to service more interest on their debt. And of course, their customers stop buying as much. Well, then, these guys are going to become zombie companies as well. So it's going to be very difficult for the whole economy to sustain these guys in a way that would allow the economy to move forward without having something uh, like a dangerous wave of inflation, or having an outcome that's just decade long, or maybe even longer. Something like Japan, decades long, but probably worse, because you know asset prices are. I wouldn't say they're. I wouldn't say they're as bubbly as they were back in the peak asset bubble in Japan, but they're very highly valued. And again, stimulus, political pressure, that's just going to put more and more pressure onto saving zombie companies. So on an economic uh, perspective, I think there's just going to be more and more of these zombie companies. Now, again, how long can you let rates fall? One, I mean, how long do you have the power to, how long does the Fed have the ability to lower and keep rates so low? That's a question. And also, I mean, how long is the Fed going to keep rates so low, uh, given the rising inflation? Right, that's also another question. And so, you know, if rates fall, well then, uh, you know, there's just going to be more and more zombie companies, which will eventually face some type of big obstacle that will kill the zombies if the government doesn't come in and inject fiscal money into these companies. But if rates rise, I think what the government could do and probably will do is just give out bailouts to these zombies, or you could have a situation like you had in 2020 where the Fed was just basically directly buying corporate bonds. Now they were doing it through a special purpose vehicle thing. It kind of just you're creating a little entity or a little business on the side that lends money, but it's just uh, I guess a legal game. You're just you're just playing with the law, and it's basically the Fed buying corporate bonds. Except, the Fed said they weren't buying junk bonds, but if rates rise, the Fed will need to buy junk bonds, and I think that's probably one of the most likely outcomes if the zombie company can keeps on getting kicked.